Assalamu alaikum. In this video on oil and gas accounting, we are going to talk about drilling and development costs under successful efforts method. Drilling cost is among the largest expenditures made by exploration and production companies. We will talk about financial accounting treatment of exploratory drilling costs and development cost that includes drilling and non-drilling cost. But in the beginning of this session, I would like to thank my son, Muhammad Abdullah Khan, who gifted me an iPad along with all the necessary accessories without which making these videos would not have been possible. I would like to thank Nabia Khan for helping me out in preparing these awesome slides. I would like to thank my wife Samina for her care, encouragement, and constant support, who allowed me to use time for her in making this video. The purpose of an exploratory well is to search for oil and gas. The existence of future benefits is not known until the well is drilled. Future benefits depends on whether reserves are found. Such wells are drilled outside a proved area or within a proved area but to a previously untested horizon, or it cannot be associated with specific proved reserves until drilling is completed. A development well is a well drilled within the proved area of a reservoir to a depth known to be productive. The existence of future benefits is highly visible. Under successful efforts accounting, only successful exploration costs are considered as a part of the cost of finding oil and gas, as a direct relationship is required between costs incurred and specific reserves discovered before costs are ultimately identified as assets. However, since the purpose of development activities is to build a producing system of wells and related equipment, both successful and unsuccessful development costs are capitalized. The cost of drilling an exploratory well is expensed if the well is dry and capitalized if the well is successful, while the cost of drilling a development well is always capitalized, regardless of the outcome of the well. Intangible drilling cost includes the intangible or non-salvageable costs of drilling up to and including the cost of installing a Christmas tree. The term Christmas tree refers to the valves, pipes, and fitting assembly that is used to control the flow of oil and gas from the wellhead. It is located at the top of the well on the surface of the land. Equipment costs include all tangible or salvageable costs of drilling and development up to and including the Christmas tree, plus both intangible and tangible costs past the Christmas tree. In order to consider whether an item is before or after the Christmas tree, the physical flow of the oil and gas should be considered and not the time of occurrence. It may be interesting to note that in case of oil and gas accounting, some tangible costs as casing that are not salvageable are considered equipment, while other tangible costs such as cement or drilling mud that also are not salvageable are considered to be intangible drilling cost. Let us look into an example now regarding intangible drilling cost versus equipment. Now, Lucky Company incurred acquisition or purchase cost of 40,000 for casing and installation cost of 5,000. Now casing is subsurface well equipment and is therefore before the Christmas tree. So the intangible drilling cost will be 5,000, the installation cost, and 40,000 is the purchase cost for equipment. In the second case, the intangible drilling cost will be 0, as all the costs are past the Christmas tree. So the intangible drilling cost is 0, as all costs are considered to be equipment cost, since these costs are past the Christmas tree. So the equipment cost will be 10,000 plus 2,000, that is 12,000 purchase cost and installation cost. In the third case, you can see that the cost is related to drilling a well, and this is before the Christmas tree. So the intangible drilling cost is 15,000 and equipment cost will be 0. In the last case, the cost is past the Christmas tree. So all costs that are considered to be equipment cost, since this cost is past the past the Christmas tree, so equipment cost will be 15,000. This is the list of costs related to drilling an exploratory or development well that are usually considered intangible drilling cost. These costs are given in the order in which they are usually incurred. Note that the costs listed in the item 2 are past the Christmas tree, but because they are intangible and directly related to the process of drilling a well, the costs are considered intangible drilling cost. This is the list of other types of wells for which intangible drilling cost is incurred. Let us now talk about exploratory drilling cost. Exploratory drilling cost can be classified as non-drilling cost. That includes G&G cost, cost of carrying and retaining undeveloped properties, and bottom hole contributions. Drilling cost includes the cost of drilling and equipping exploratory wells and the cost of drilling exploratory-type stratigraphic test wells. An exploratory well is any well that is not a development well, a service well, or a stratigraphic test well. It is a well drilled to find and produce oil or gas in an unproved area, to find a new reservoir in a field previously found to be productive of oil or gas in another reservoir, or to extend a known reservoir. Stratigraphic test wells are customarily drilled without the intention of being completed for hydrocarbon production. It is a drilling effort geologically directed to obtain information pertaining to a specific geological condition. Stratigraphic test wells are classified as exploratory type if not drilled in a proved area, or development well if drilled in a proved area. Drilling costs are temporarily classified as wells in progress or wells in progress, lease, and well equipment. The term well in progress is used in place of the FASB terminology uncompleted wells, equipment and facilities. You can note that wells in progress therefore include not only unfinished wells but also unfinished equipment and facilities. The cost of drilling exploratory wells and the cost of drilling exploratory-type stratigraphic test wells shall be capitalized as part of the enterprise's uncompleted wells, equipment and facilities pending determination of whether the well has found proved reserves or not. If the well has found proved reserves, the capitalized cost of drilling the well shall become part of the enterprise's wells and related equipments and facilities, even though the well may not be completed as a producing well. If, however, the well has not found proved reserves, the capitalized cost of drilling the well net of any salvage value shall be charged to expense. When drilling reaches the targeted depth, a decision must be made as to whether the well has found proved reserves. If proved reserves have been found, both wells in progress account balances will be transferred to wells and related equipment and facilities. We will be looking into all these accounting components when we solve some illustrations. In addition, if the well is the first successful exploratory well drilled on the property, the unproved property account will be reclassified or transferred into a proved property account because proved reserves have been found and are not attributed to that property. In case the exploratory well is abandoned, the cost of plugging and abandoning in addition to the capitalized cost in the wells in progress accounts net of any salvaged equipment must be written off to dry hole expense. If the lease is also abandoned, the net amount capitalized as unproved property will be written off as surrendered lease expense or charged to the allowance account, depending upon whether the property is significant or insignificant. Let us now look into an illustration and we are going to apply these accounting norms for exploratory and stratigraphic test wells. On January 2, 2008, as a result of G&G work done in 2007, Lucky Company decided to lease 1,000 acres at 20 per acre. The lease was undeveloped. So when the lease is undeveloped, unproved property is debit and cash is credit. Early in 2008, Lucky Company decided to begin drilling operations and incurred G&G cost of 5,000. So again, now you see this is a G&G cost. So this will be classified as an intangible drilling cost and that is debit and cash is credit. In preparing the drilling site, Lucky Company incurred cost of 12,000 in clearing and leveling the site, and again this is an intangible drilling cost and that is debit and cash is credit. Additional preparation cost of 4,000 were incurred in digging a mud pit, and digging a mud pit is a intangible drilling cost, and this is installation of water pipeline is a lease and well equipment account. So they are debit and cash is credit. Okay, next is Lucky Company purchased pipe and casing for the well at a cost of 600. This is a lease and well equipment cost and cash is credit in this case. Then Lucky Company hired a drilling contractor on a footage rate contract, and as usual in such an agreement, payment was contingent Upon the contractor drilling to a specified depth, the well was spudded. Other drilling was begun early in June and contract depth was reached in late July. So Lucky Company paid contractor 140,000. Again, this is an intangible drilling cost. Then in evaluating the well, Lucky Company incurred cost of 8,000. A well log was run and a drill stem test was made. Again, this is an intangible drilling cost and that is debit. Based on the well log and drill stem test as well as other tests performed, Lucky Company decided to complete the well. Casing was set and casing either installed by cementing between the pipe and well at a cost of 35,000. This is a lease and well equipment cost for casing for the well and 6,000 for cementing services. This is an intangible drilling cost. Then Lucky incurred acquisition cost of 8,000. Now this is an intangible drilling lease and well equipment cost, and installation cost of 1,000. This is an intangible drilling cost for a string of production tubing through which the oil and gas was produced. Next, Lucky Company incurred purchase cost of 5,000 for a Christmas tree and installation cost of 3,000. So installation cost is an intangible drilling cost and they are purchasing equipment for a Christmas tree. So this is a lease and well equipment cost and cash is credit. Next, company incurred 4,000 in perforating and acidizing the services. Again, this is an intangible drilling cost and cash is credit. Now here comes the important part. The work on the well is finished and proved reserves have been found. So if that is the case, then we have to make two entries. One to transfer the cost of well from an unfinished good account to a finished goods account, and one to reclassify the lease as proved reserves. So first of all, we will look into the balances of work in progress, intangible drilling cost. So in transaction number B, the intangible drilling cost is 5,000. For C, this is 12,000. For D is 4. Then E is lease and well equipment. Then we have F, and F is 140,000. Then we have G, 8,000. H, 6,000. I, 1,000. J, 3,000. K, 4,000. Anything else? No, we don't have. So we will make the total, and the total will be 183,000. So we are going to close work in process intangible drilling cost, and this account will be transferred to wells and related equipment and facilities intangible drilling cost. We will also look at the balances for lease and well equipment, and you can see for transaction number D. For number D, we have 2,000. E is 6,000. H is 35,000, I is 8,000, and J is 5,000, and the total is 56,000. So these accounts are going to be closed and they will be transferred to wells and related equipment and facilities, intangible drilling cost, and lease and well equipment. So this is a total of 183 for intangible drilling cost, and wells and related is 56, and these balances are transferred to the wells and related equipment and lease and well equipment. Then we are going to go to the second part, and the second part is to reclassify leases as proved. And if you can remember, the proved was unproved was 20, and this is going to be transferred to proof. So proved property is debit and unproved property is credit. Okay, next, Lucky Company purchased pipes, flow line to lease tanks, storage tanks, and separators. Now these are lease and well equipments, and cash is credit. Now don't forget that installation cost is added to the cost of the equipment. So 15 plus 11 is 16. Now if instead, after evaluating the well in part number G, Lucky Company decided that the well was dry after part number G, and if that is the case, then the cost from A to G would have been incurred. That means these would have been the cost for the intangible drilling cost, and we would have recorded the, and again if the for lease and well equipment GH G okay, so that is 2,000 and 6,000. So we can make a total of this will be 169,000. So work in progress intangible drilling cost is credited by 169, and work in process lease and well equipment is credited by 8,000. Dry hole expense are going to be debited in this case because the well is dry. So it is important to distinguish between abandonment of the well and the abandonment of the lease. In this case, only the well has been abandoned, and therefore no entry would be made relating to lease, that is the unproved or proved property account. Let us do some exercises now. Now, Hayes Oil Company has the following transaction acquired during the year. They have acquired an undeveloped lease, and when they are acquiring an undeveloped lease, so unproved property is debit and cash is credit. Then they have paid on drilling contractor 250,000 for this is intangible drilling cost, and they are paying for equipment 75 and 50, so that makes 125. So 250 is debit for intangible drilling cost and 125 for lease and well equipment, and cash is credited by 375. Then paid cost in evaluating the well, again this is an intangible drilling cost. Then completion cost for fracturing and perforating 25,000. So again this is going to be debit for intangible drilling cost. Don't forget that once we have done it, we have to make two important entries. One is to transfer the cost of the wells from an unfinished goods account to a finished account. So again we are going to have the well in process intangible drilling cost, and wells in process lease and well equipment. And we have 250, then we have 20, and we have 25. So this makes 295,000, and that is what we have over here, 295. And then for the lease and well equipment, we have only 125, and that is what we have over here. So 290 wells and the well in progress are transferred to wells and equipment intangible drilling cost, and wells in progress lease and well equipment is transferred to wells and equipment cost. Then finally, we have to reclassify the unproved property into a proved property. So unproved property is credit and proved property is debit. Next, we are going to go for another question or exercise, and in this case, ETA Oil Corporation incurred the following costs during the year: began drilling an exploratory type stratigraphic test well and incurred 60,000 of IDC cost. So wells in progress is debit and cash is credit. And there is a 20,000 in equipment as well. But look at part A. The well in A was determined to be dry, and when it is dry, so we have to close well and equipment because this is successful effort method. So dry hole expense is debit and intangible drilling cost is credit. So that finishes part A, and we go to part B. Began drilling an exploratory type stratigraphic test well and incurred 80,000 of cost. So we have we have 18,000 of cost, and remember we have 20,000 for equipment over here, that is debited here, and this is 80,000 wells in progress, and cash is credited by 80,000. Now we have found proved reserves. So obviously we are going to transfer the unproved to the proved one, and we will be closing the wells in progress as well. So again we make the T account for wells in progress intangible drilling cost and wells in progress lease and well equipment. Now wells in progress for transaction A was 60,000, and then it is a dry hole, so again it is credited by 60. And then we have wells in progress for 80,000, so that is what has been recorded over here to close it. And then we have 20,000 for the equipment, so this has been transferred to wells and equipment intangible drilling cost and lease and well equipment. Then we go to number C. Began drilling a development type stratigraphic test well and incurred 250,000 of intangible drilling cost. So again this is intangible, so this is debit and cash is credit. Then for number C, the well in C was determined to be dry, and when it is dry, so again we have wells in progress intangible drilling cost has to be closed for 250. So we have 250 over here, and that becomes 250 over here as well. 80,000 we have already closed before, if you can remember here. So wells in progress, so wells in progress is credit, and wells and equipment intangible drilling cost is debit. Then we go to number D. began drilling a development type stratigraphic test well and incurred 300,000 of intangible drilling cost and 80,000 in equipment cost. So we have debit and cash is credit. And once again we have to close the well in progress and intangible drilling cost. So wells and equipment, wells in progress, intangible drilling cost and lease and well equipment are credit, and wells and equipment, intangible drilling cost and lease and well equipment are debit. We will be looking into one more illustration, rather two more I believe. So here they say record the following transaction for Chavez Energy Corporation. They have incurred a cost of 40,000 in preparing a drill site. So again wells in progress is debit and cash is credit. Then they have contractor was paid 400,000 on a day rate basis, all tangible. Now again you see this is all intangible. So again well in progress is debit and cash is credit. Then we go to number C, equipment casing cost 80,000 were incurred. So well in, now this is about casing, this is an equipment. So well in progress, lease and well equipment is debit and cash is credit. And cost of 70,000 were incurred in evaluating the well. So this is an intangible drilling cost. So wells in progress, intangible drilling cost is debit and cash is credit. Then they have decided to complete the well and they have incurred a cost of 45,000 for perforating and fracturing and 60,000 for cementing. So 60 plus 45 is 105, the intangible drilling cost, and equipment for 100,000. So that is debit over here and cash is credit. Now once again we have, don't forget that once we finish this task, we have to record two journal entries, and one is to transfer the cost of the well from an unfinished goods account to a finished goods account. So we have a well in progress over here, and if you look here we have 40,000, we have 400,000, then we have 70,000, and then we have 105,000. So the total is 615,000. And over here for lease and well equipment we have 80,000, and 100,000. So the balance is 180,000 in this case. So wells in progress, intangible drilling cost and lease and well equipment are closed, and wells and equipment, intangible drilling cost and lease and well equipment are debit. We go to the last exercise in this video, and here you see we have Todd Corporation incurred the following costs during the calendar year 2019 in connection with the Grim lease. Acquired 600 acres of Grim lease at a bonus of 70. So 600 times 70 and the acquisition cost of 15. So unproved property is debit and cash is credit by 57,000. They have incurred the following cost, and these costs are given over here. And then they are required record the above transaction. Hint, this the type of equipment installed when the well reach target depth indicate whether the well was successful or dry. We have already talked about this before. So let us see the accounts for well in progress intangible drilling cost. We have 5,000, and then we have this 20,000. Surface casing is going to be for lease and well equipment. Then contractors fees 175,000. Let me put it down here as well. 10,000 for surface casing. Then we have equipment rentals of 200,000. This is intangible drilling cost. Drilling fluids is 35,000. Then we have fuel 9,000. Drill bits is 20,000. Then cementing services 6,000. Cementing services is 5,000, and casing crews is 6,000. Then we have roast about labor 8,000. Then we have hauling and transportation 7,500. So this makes a total of 490,500. Then we have wells. We have already recorded surface casing 10,000. Then we have production casing. This is a lease and well equipment cost of 36,000. Then we have 11,000, 5,500. This is for lines and connections, pumping unit, lease and equipment. 6,000 for casing head and connection. Then we have tubing. Then we have separating and treatment equipment. You see the word is equipment. Measuring equipment 300. And then downhole pump and rod, again this is an equipment 5,600. So the total is 140,500. So we have incurred these expenses. So intangible drilling cost is debit, lease and well equipment is debit, and cash is credit. And then these balances will be transferred to wells and equipment. So we are closing wells and progress, intangible drilling cost, and lease and well equipment. And lease and intangible drilling cost, lease and well equipments are debit over here. And finally we are going to transfer the unproved property to the proved property. So proved property is debit and unproved property is credit. So this completes the first part on drilling and development cost under successful efforts method. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question regarding this session, then please don't hesitate to ask in the comment box or by email, and inshallah I will reply you back. Happy learning.